flow is important for everyone, but it's especially important for retirees as income from working turns off and income from retirement savings turns on. Here to discuss that is Mark Mappa, author of Cash Flow is King. Think cash flow, not rate of return. You can't spend rate of return. Mark holds 8 professional designations, including the CFP. He's a fiduciary and the president of Mappa Wealth Management. Welcome to the program.
Hi, good afternoon. Thank you for having me. I'm excited to talk with you today.
Awesome. Okay, so one of the most important retirement planning concepts you stress in the book is that people should think about cash flow rather than their portfolio's rate of return. What do you mean by that?
Correct. So everything we do revolves around cash flow. Cash flow matters a lot. In fact, I call cash flow our financial lifeblood. Cash flow allows us to spend, pay our bills, pay our mortgage payments, save for our kids' college, retirement savings, and invest and accumulate money. That's the key around cash flow. And that's why I named my book Cash Flow is King. So the key to it is if you're a retiree, you've accumulated assets, and the objective is you want to spend that money in retirement because you're no longer working. So I look at it as you want to maximize that cash flow as much as possible and minimize the risk in doing so. So the mindset should be thinking in terms of cash flow to do that. And there's a number of ways to create that maximization of cash flow. The other thing is when you're saving and investing towards retirement, you also need to be thinking in terms of cash flow. What I mean by that is a lot of people are thinking, what rate of return I can get on my investment and how much growth I can get. But what people don't realize is that dividends, for example, are a great source of cash flow. So if you had an investment, a stock or a mutual fund that paid, say, a 4% dividend and it hit a 5% growth rate, that's a 9% total rate of return. If the investment, stock or mutual fund didn't have any dividend or cash flow, you need a whole growth, the whole investment would have to grow at 9% to equal that investment that only gave, that person gave you cash flow. That's one part of it. And then, of course, we hear like interest earnings is a part of cash flow. And everybody's heard of the benefits and the power of compounding interest as well. The other thing I want to add in is the S&P 500 index, the last 80 years, 44% of that index total return was a result of reinvesting dividends. So the key is that's a big factor and that's a big accumulation goal. So it's a cash flow mindset that everybody should have regardless of what stage they are, pre-retiree or in retirement.
Among the worst retirement planning blunders a person can make is outliving their financial resources. It's hard to go back to work when you're 80 and you've run out of money. How can people avoid this fundamental mistake?
Yeah, absolutely. Very good question. So number one, you're probably not going to get hired at 80, but also do you have the mental or physical capacity to work if you were forced to go back to? So the answer is really planning, planning, planning. You want to do as much planning as possible so you can prepare yourself. You want, again, it goes back to maximize, especially in retirement, it's about maximizing your cash flow with the least amount of risk. So you plan ahead, you create strategies, investment products, investment tools that can help you maximize that cash flow, that can generate that on a reliable and even guaranteed basis. So just to give you some ideas, there's obviously Social Security that most people have. Social Security generally isn't enough to cover everyone's total income or cash flow needs in retirement, but it's still a guaranteed source of cash flow. Pensions are great, but most people don't have pensions nowadays, but those that do at least have that guaranteed lifetime income. And then for those that don't have a pension or Social Security is not enough, I like to create personalized pension plans, and that's in the form of using an annuity. And nobody has to work for a company that offers a pension. It has nothing to do with the government. It's just a third leg of providing reliable and guaranteed income that can potentially help you mitigate that risk of running out of money later years in your retirement.
If you're just joining us, we are talking with Mark Mappa, author of Cash Flow is King. Check out his latest book. It's 5-star reader rated and it's available at Amazon.com. According to usdebtclock.org, the U.S. government has over $127 trillion in unfunded liabilities, and it's just a matter of time before there's a major reckoning day, and it will likely come in the form of higher taxes. Am I being alarmist, or do you think that this is a real risk facing retirees?
Not at all. You're not being an alarmist. It's a very real risk. And I would say I even see retirees today, even in this low interest rate environment, being impacted by, we're talking about federal income taxes rising. But right now, state income taxes, sales taxes, property taxes, county taxes are all increasing. Permits for, whatever you need. Like somebody told me the other day that I'm in Illinois. So in Illinois, the car license renewal has doubled. So those costs are going up already, and that is with a very low, historically federal low income tax bracket. But I do believe that we will be, that the government will be raising to cover the debt and the expenses that the government incurs. The tax rates will be going up at some point. So my strategy and recommendations is you want to create a plan and a strategy. And again, these are cash flow planning strategies and plans that can generate tax-free income during retirement. It doesn't necessarily have to be all of your retirement income tax-free, but if you can maximize that, then you don't have that worry or concern. So if federal tax rates go from 15% to 35% or 50% or whatever, you're not impacted by it because whatever you take out is tax-free. So that's the key, is I think, and especially for younger people. So my book is not just for those at retirement. It's great for those at retirement, but even for young people, I encourage them to read it because the emphasis is on creating that cash flow, Roth IRAs and strategies like that they can make sure that down the road they have a pot of money, a bucket of money they can take out without incurring income taxes.
So people usually think of risk in terms of losing money in the stock market, but there's another overlooked risk that deals with the sequence or order of investment returns. Can you tell us a little bit more about this type of risk and why it matters?
Absolutely. So when you're in the accumulation phase, when you're saving and investing towards retirement, sequence of returns risk really doesn't matter. Doesn't matter at all. And what I mean by that is you had an investment in the first 2 years, the rate of return was down 10% the first 2 years, and then years 3 and 4 it went up 10%. And you had a separate investment over the same time frame, but that investment, the first 2 years was positive 10% and then dropped negative 10%. You have the same exact rate of return, the same value of your account. So it didn't make a difference. The problem, the risk, the concern is in the distribution phase when you're retired and you're taking money, cash flow out of your retirement assets. Then that becomes a problem. And I have a lot of examples in my book where I show if you start out and all of a sudden the markets are down or you have very low returns and you're starting to deplete the value of the account. So if you start out with, let's say, for example, $1 million and you're taking out a 5% withdrawal rate, that's $50,000 a year. And the next year the market drops, say 20%. So your account value is basically $750,000. Why? You had $1 million, you dropped 20%, you took out $50,000. Now the next year you still need $50,000 to live off of. So you now have a higher withdrawal rate to take out. You're probably taking closer to 6.5%, 7% withdrawal rate. The question is that sustainable? And what happens if the next year the markets are down or the markets have a very low rate of return of only 1 or 2%? That's a big problem. So absolutely, every retiree, especially if they're relying on the stock market or even the bond market for their investment cash flow during retirement, that's a big concern. And again, it goes back to what we talked about earlier. You don't want to run out of money in your 80s and have no strategy at that point in time.
Okay, we're talking with Mark Mappa, author of Cash Flow is King. Check out his latest book. It's available at Amazon.com. The 4% rule has long been used as a rule of thumb for a safe withdrawal rate that won't deplete your retirement savings. The problem is bond yields are at a multiple decade lows, and with 2% yields on 10-year treasuries, keeping up is going to be hard, especially for folks with bond-heavy portfolios. Can you talk about that, please?
Absolutely. So again, the old rule of thumb is that you can safely withdraw 4% out of your investment portfolio in retirement and not deplete the account. with interest rates so low, historical lows, and we're in a strong, likely tail end of a bull market, the types of stock market returns may not be where it's at. So that's a big risk and concern, and it falls to what we just talked about with sequence of return risk. If you're taking out 4% and the markets have losses, your retirement portfolio, or 1 or 2% rates of return, you're going to be in trouble. You increase the risk of running out of your retirement assets. And I like to say, no assets, no income or cash flow on it, unless you set up strategies that have ongoing, such as annuities, or you have your Social Security and pensions. So really you have to think outside the box. You have to be creative and plan ahead, working around that. There's other financial products or investment strategies that don't limit you just to relying on low interest rate bonds, or even CD rates are super low, or just relying on the growth of the stock market that may or may not occur.
Okay, one last question before you take off. The Setting Every Community Up for Retirement Enhancement, also known as the Secure Act, passed in December 2019. It introduced major changes that increases and expands retirement savings. What one or two aspects of the Secure Act have caught your attention?
Yeah, so the two big ones that caught my attention, a lot of people are talking about, one is the change in the age for the required minimum distribution, RMDs. It was 70 and a half, so what that means is anyone who has an IRA, that not a Roth IRA, but a traditional IRA or rollover IRA, once they turn age 70 and a half, whether they need the money or not, they're required by law to take out a minimum distribution amount. That's the term, required minimum distribution. That changed from 70 and a half starting this year, 2020, to age 72. Honestly, I don't think it's a big deal. It allows you to wait another year and a half, but it's still a year and a half that you don't have to take it out if you don't need to take the RMDs. But the bigger one, the more relevant one, is the elimination of the stretch IRA. And that was a big estate planning tool. And again, what the stretch IRA allowed one to do is it was for beneficiaries, not the IRA owner or holder, but those that would inherit an IRA. Instead of having to cash in all the money at once, especially if it was a large IRA, $500,000 or $1 million, and pay taxes all at once, they were allowed to stretch that IRA over their life expectancy. So it could be 15, 20 plus years, and it was a great strategy because they could take money out without penalty, regardless of their age, and just have to pay tax on what they took out based on a certain IRS factor, but allowed the IRA to potentially continue to grow. Well, with the new Secure Act, that's been eliminated, and what the rule is that IRA account has to be depleted within 10 years. So they don't have to take money out any time within 10 years, but by year 10, it has to be taken out. So again, that limits the estate planning strategies, and it could very well impact taxes. So that's where it goes back to going forward, create that cash flow in those savings vehicles that aren't taxed, so you don't have that impact on you.
Okay, well, Mark, thanks so much for your insight and joining us. You just heard from Mark Mappa, author of Cash Flow is King. I'm Lynn Dolan with ETFguide. Thanks for watching.